All right, Tanner, we are live. Thanks so much for joining me again today.
What up, Jess? How are you?
Good, good. How's it going this morning?
Hey, it's going good. We got a little bit of a rainy morning today, so we're gonna get our enthusiasm up, and we're gonna make this happen and talk about some assumption info.
I know. I think it's supposed to rain all day today. I was bummed. I was hoping to get out for a run later, but I'm like,
Yep.
it's gonna be wet. So, um, well, I'm excited. For those of you joining us today, we are talking about VA assumptions. That has been a huge topic of conversation lately, even though we're seeing rates coming down. Assuming a loan at 2 point whatever is still really interesting to people. We're seeing it in agent marketing. Listings are saying, hey, 2.375, assume this. And so Tanner is here joining us to talk a little bit about that. And we're just going to kind of go over all the information. So if you've been thinking of assuming a loan, this would be great. But even if you're a seller that you have an assumable loan, which would be a VA or FHA loan, definitely tune in also because it's important for you to know some of the timelines and some of the nuances, I think, that go into it.
Yep.
So Tanner, where do you want to start? You want me to pull up your slides?
Let's do it.
Okay.
So, just a little background on this, Jess. I got involved in learning about VA assumptions back in 2018. That was the last time that we saw a serious rate increase, which was nothing like what we had the last couple months.
Right.
But that's when I got started, and I actually had a point of contact at the VA Roanoke office who helped me put my presentation together and gave me the information that I wasn't sure on. So, as we go through it, that's where that
The problem with being live.
right. That's right. But so let's go ahead and turn to on these. Let's see if I can scroll down or what I need to do. There we go. I am an instructor for Fredericksburg Association of Realtors. So some people have heard me talk on these before, but that's a little background on me there. So why do we need to know about VA loans in our area, Jess? Well, the biggest thing is because we are in a heavy VA area. If we're talking about kind of the Northern Virginia area, this is the counties across the United States for VA loans. And as you can see on there, Stafford County in particular is number 30, and Fairfax is actually number 9, which kind of surprised me that it was higher than like Prince William and then also Stafford. But that gives you an idea of where we stack up for VA loans. So we've always known we're a heavy military area and veteran area, but this is just confirming that. Now, let's see. We're going to go and get down to, I apologize. I don't know why I decided to go to that one. We're going to get over to the VA assumption information. So now, why do we need to know about VA assumptions? The biggest thing is going to be that the rates have, as we know, went up, and they went up quick. We had never seen anything like it. On March 21st, if you had asked me what the going rate was, I would have said 4.25, and a short, like 55, 60 days later, it's like, bad news. We're now up to 5.625. And I could have kept this chart going because it went up from there as well. Now, good news for potential buyers who are watching this videos or sellers that are thinking of selling and selling through the assumption route. Rates have come down, so we're kind of in that 5.25 range right now. So something to keep in mind that they are starting to trend back down. Now, for historical perspective, this is where we were at back in 2016 through 18, the last time people were really flipping out about the interest rates. So it's good to know and really appreciate that how quickly rates did go up on us. And that has obviously had an impact on the market, but with them starting to stabilize, I'm starting to hear agents are getting busier, sellers are getting ready to list their house, and everybody has buyers lined up for the spring and summer. So.
Absolutely. I mean, I'm definitely seeing that on my end. And I know a lot of agents in my brokerage are too, and other agents that I collaborate with. So I think it's going to be a very busy spring.
Yep.
And the assumption piece is, I think, going to be really huge. Like we were talking about, I have a listing that just went under contract with an assumption, and that agent has several going on her end. And so there's a lot of talk about this.
Yep. Assumptions are becoming a big deal. And when people go, well, why should I assume a loan? Right? Well, what is the benefit? I want to show you a couple slides that I put together just to give you a ballpark on what the payment difference is. If you're looking at, sort of, in this case, a $425,000 home, you take over a 3.25% interest rate versus having to get a 6.5%, which is not where we are on rates right now, but we were about 30 days ago. That's
Yeah.
an $837 difference. And if you did the same thing on a $600,000 home, we're almost at $1,200. For a lot of people, including myself, that is real money. So, $12, not a problem. 1,200, that's an issue.
Yeah, and just for folks watching, just to be like extra clear, that's per month.
Right. Not
That's
over
just
a
in your
year.
monthly payment. Yeah.
Exactly. So that's really illustrates why assumptions and assuming someone who has a low interest rate makes sense in a lot of cases.
Yeah.
Now, one thing I always like to pass along, which is maybe not in our area that we'll see too much, but you don't need to be a veteran to assume a VA loan. It is preferred for a seller, but it is not a requirement. And
Okay.
this is confirmed. I actually got an email back from the head of the assumption department in Roanoke because I had asked the question
Yeah.
and wanted to make sure that I gave the correct information. So it does not need to be a veteran.
Awesome. And I think something, just a real quick side note for sellers going, oh, cool, there's more people that can assume my loan. If you have a VA loan on your home and a non VA borrower assumes it, your eligibility will remain tied up. That's not going, you have to have a VA borrower take over your VA loan to release your, eligibility. Correct, Tanner?
That is correct.
Okay.
Um, and I have a slide for that coming up, but just want to
Okay.
pass along. So these are actually regulated by the VA. They determine how the process is supposed to go through. So different while every lender will have slightly different twists on how they allow an assumption to proceed, the process itself is supposed to be the same with the VA. So this is an actual document that they put out. All the lenders are familiar, and so they know what they need to do. Now, some of the highlights, just what I've always found interesting, is that it only costs $300 to do an assumption, where it would cost $1,000 for a new loan to go in. So for
Okay.
a buyer and I don't want to clarify too, that's for the lender part, not for the title fees and homeowners
Great.
insurance stuff you take over, but just for the underwriting fee. This was an actual closing disclosure that I did that I was given from somebody that did this, showing that it is indeed $300. And even though that guidance is almost 10 years old now from the VA, that's how much it costs. So, I mean, that basically gets you what? Two things of eggs these days, somewhere around there. Is that what the
Yeah,
numbers are?
something about that. Maybe a gallon of gas on top of it.
Yeah, something like that. So it's pretty cheap. Now let's talk about, for your sellers out there, Jess, some of the important things they need to know. So the first step in the assumption process, and you can talk to this because you just went under contract on a property,
Yeah.
is they will need to reach out to their current lender to find out how this process starts. So can you talk about what you found with your situation?
Yeah, so my sellers have Carrington Home, was it Carrington Home Mortgage or something of that nature? So Carrington is their processor. So we had to give the seller directly. No one, I couldn't make a phone call. They had, whoever was on the loan had to call in, and they had to provide permission for the buyers to be, potentially able to call and talk about the loan. But then also for Carrington, the seller had to request an assumption packet. And the packet is a bunch of forms that the seller has to fill out some and the buyer has to fill out some. And I think, we're definitely seeing how infrequent this has been because Carrington is mailing the packet to us, or to the seller. So, when we talk about timelines and things, which I know you're going to get to too, it's definitely a different process than I think anybody has really seen before if they haven't been through one. But so that
Right.
was Carrington's specific process. And so once the paperwork is filled out, it'll get sent back and then we'll go from there.
Right, and we'll get into kind of what's on that paperwork in a moment, but I would say for those who haven't bought a house in the last 10, 15 years, how the process works now is the loan officer is going to send you electronically the loan application for signature. We're not going to have this mail back and forth situation. So it's definitely old school would be the way I would put it. Now,
Yeah.
this next slide, just to give you an idea of where back in 2020, that's when everybody was doing a ton of VA loans. So people that had a VA loan were most likely to refinance in 2020 because the rates were as low as we've ever seen. And these are the lenders that did the primary bulk of the loans. Now, in the case you mentioned, Carrington, I cut it off at 10, but I want to say they were in the top 20. So they were on the list. I just cut it at 10. Now, when that packet comes over for a buyer that is going through this process, a seller that has requested this assumption package, these are some of the things that are going to be asked of the potential buyer.
Okay.
They're also going to have to provide pay stubs, W-2s, bank statements, everything that I, as a loan officer, would ask them for. The current lender will as well, because just one of the things that's really important to point out about these is that you may want to work with me, Tanner Mulvihill with Bayfield Home Loans, but if the current loan is with Carrington, it will be staying at Carrington. They already have the loan, so it's going to be staying there, and that's why you have to request the package from Carrington. Whoever the current lender is, they're going to keep the loan.
Okay.
Yep.
Makes sense.
But so you have to provide that information. They're also going to pull your credit. So it's important to know that they're going to do a credit check on you.
Okay.
And they're going to want to determine how you're paid. So if you have something that's kind of unique, maybe you're a self-employed individual, be prepared to provide lots of income documentation, tax returns, things like that. If you are what I would call a standard W-2 employee, it's pretty simple. You send over your W-2s and you're good.
Okay. I think I'm going to jump in real quick too. I think something important for people to know too is that so on the buyer side, if I was representing you and your plan even from day one was to do an assumption, we still need a pre-qualification letter from a lender to submit with our contract. So we do that because it is important to show a prospective seller that you are qualified. Otherwise, because of this process, we would have, the seller would have no idea if you're even qualified to get, to assume their loan if you don't already have a pre-qualification from a reputable lender like Tanner. So, that does mean like 2 applications potentially, but then you also have a fallback plan. The seller knows that there's a fallback plan in case something goes awry or timelines need to be adjusted. So,
yep, very good point. And there's also a couple more that I'll point out here in just a moment. So after that assumption package that your buyer on your listing is going to be submitting to Carrington, they're going to review everything and then issue basically an approval, whether they're in, as we've talked about, the buyer on the house is well qualified, not going to be a problem. But if it's a little bit more sketchy, they do have the right to deny an assumption. So something to keep in mind if somebody's trying to assume a loan and they are kind of qualifying by the skin of their teeth, they may get denied.
Okay.
So now some of the concerns that you're going to run into for a seller, the biggest one is restoring their full VA eligibility. Because if I'm a seller and my current eligibility is tied up in the property, I want to be able to get that back. Yeah. And if it is a non-VA buyer, that is not going to happen because the seller will still be on the hook for the property, their entitlement portion, not like their credit, not if, not insurance or anything like that, but their entitlement with the VA is still on the hook if it's a non-VA buyer.
Tanner, quick question about that or a conversation. So of course, even if the eligibility is tied up in a current home, that wouldn't necessarily prevent a seller from buying a new home, depending on the amount of eligibility they have, correct?
That is correct. If they have enough eligibility remaining to do that, then they can. So I think I might have a slide on that coming up. Oh, perfect. So, so if somebody is assuming like a $300,000 loan from a seller in our area, they're still going to have the remaining amount up to almost 1.1 million. And we're talking about Northern Virginia counties. So if somebody's watching this in North Carolina or somewhere with the county limits or less, would not apply the same. But something to keep in mind, yes, you do have that option. However, in our area, most likely it's going to be a VA buyer for a VA seller.
Yep. And my second question on that is if it, again, is a non-VA buyer, when does that eligibility get restored? When they sell the home or refinance or something of that nature? Okay.
Correct. When they refinance or if they sell the property, then the eligibility for the seller will be returned back to them. Yep.
Okay. Gotcha.
Yep. Okay, so what happens if it is a veteran? Now, when you mentioned that the person still had to be pre-qualified, they had to send in that letter to say that, hey, they're able to purchase this house. Now,
Mhm.
did you receive proof of funds, which we're going to go into in a minute as well? Okay. The
Mhm.
other thing that I would recommend agents who watch this or clients is you also want to show that you have your full VA eligibility remaining.
Mhm.
Because let's say that I was a potential buyer of this house, but I already had a rental property in North Carolina. And so a portion of my eligibility is already gone. And now I'm trying to buy this, $900,000 house on an assumption.
Right.
Well, if I don't have my full eligibility, the sellers is not going to get theirs back too. So I would, if
Okay.
I am the seller, I would want to see the buyer's eligibility too.
So just to recap what you just said, Tanner, because I think that's super important. So if, the buyer that only has a portion of their eligibility, then the existing loan that's being assumed would basically kind of be split between the two. Okay, that's really interesting.
And sellers aren't going to want that because they want their full eligibility back.
Absolutely. Um,
Now, go ahead.
you might have a slide on this, so tell me if you do. But I think it's important too for just because an eligibility gets tied up doesn't mean that that veteran is still like liable for the loan in some way.
Correct. Like if the loan goes to default, that is not going to be on their credit report,
Yeah.
but they will lose that portion of their eligibility until that the claim is paid back to the VA.
Okay.
So that's the biggest thing. If that portion of eligibility is gone, you can get it restored by paying the VA back,
Yep.
but I'm sure the number of people that have done that is very slim to none. So
Yep. Okay. Understood. So if someone were to buy, assume a loan, they're ineligible, it ties up the eligibility, and then in 2 years they short sell, then it's, that eligibility could be tied up for however long.
forever until
Yeah.
the veteran pays it back, even if it wasn't, they weren't the ones that did the short sale, but the VA did pay the
Yes.
claim. So
Yeah. So even though these are uncommon, definitely a lot of risk there.
yes. The ideal situation is somebody's going to have their full eligibility and they're going
Yeah.
to be willing to sign a substitution of entitlement form. And just what that means is that I, as a veteran, and I'm a former Marine, so I'm a good example. I don't have a current VA loan. If I was to buy a veteran's home, my eligibility would go in theirs place, and we just swap eligibility. So the sellers would get theirs back. I'm going to sign this form that allows that to happen,
Yeah.
and that's how it does, how we do it. It's important for an agent, if anybody's watching this, to make sure that they're looking at the right block. I
Hmm.
checked that one pretty good, just to make sure you had all your T's crossed on that when you
Yep.
got it. Now, one thing that's important to note for a seller is servicers have up to 90 days to report the sale to the VA. So that means if I am a seller and I am trying to close on one house on Monday and purchase my new home on Tuesday, that might not happen if we're talking about reusing our VA eligibility.
Okay.
So this is just a little slide to kind of illustrate the point. So if you had USA for the loan and they allow the loan to close and be assumed, they may slow roll the information to the VA to update their records. I'm
Right.
confident that a loan officer can speed that up by submitting this stuff to the VA, but
Right.
they do have 90 days.
Okay. And so again, just clarifying, so that's 90 days just to get it to the VA. Then the VA still has to actually update it.
That's a good point. That could be a little bit longer too.
So, yeah,
Hopefully within that 90 days, that process takes place.
gotcha.
Now, we're not going to talk necessarily about the selling agent part, but let's talk about the buyer for a minute because that's the
Yeah.
people who are taking this over. So the first thing a buyer needs to know about assuming a VA loan in our current market right now. So keep in mind, things could be different in 2 years for the people that bought at the peak of the market, but we're just talking about the people that have current VA loans.
Yeah.
A buyer needs to understand that they are most likely going to be bringing money to settlement. And so the biggest thing is they need to cover the difference between the sales price and the loan amount. So Jess, if you don't mind, we can use your current situation as our example.
Yeah.
What the sales price of your house, I know was 570. Is that correct?
Yeah, 570 sales price, and then the remaining mortgage was 457.
Okay. So in your scenario, which is kind of similar to this one, the buyer of the property is going to be bringing a good chunk of change to settlement. They are going to be putting
Mhm.
that money down when they assume the loan. Now,
Mhm.
just a lot of our military and veteran buyers may not have that 130,000 in my scenario here and the one purchasing your home. So what are our other options? And that leads me to this slide. There is a lender that I'm aware of that will do a second mortgage on these up to 95% of the value. And it's important to note, Jess, that you still have to put 5% down in this
Right.
circumstance.
Yeah.
Now, as a VA person, as a VA buyer, a veteran myself, we know that we can get 100% financing if I'm to go get a normal loan. But in
Right.
this scenario and with this lender, I still have to put 5% down. Now,
Right.
Jeff, what happens if the going rate on the house you're selling is 2.25, but the
Yeah.
second mortgage, the best I can get is 12%?
Right.
What,
And I think
what,
that's so huge too, like mentioning that, Tanner, because I don't think people expect the second. Because we have to realize, guys, like everyone who's watching, that a second is second in line to be paid back. There's more risk for that lender. Well, more risk means they're offsetting that by a higher interest.
That's
So,
exactly right. Because Jess, your veteran or the veteran purchasing the home, let's say their second mortgage payment was $900 a month and the first mortgage is $2,200. Well, they could completely stop paying that second mortgage, and the second mortgage lender has no recourse. They're
right,
not the first lien position. So outside of dinging somebody's credit, they really can't go after them for the property, which is the asset that allowed this to go forward. It's if they stop making the first mortgage payment, it's a different story. But second mortgage, yeah, doesn't happen. So sometimes, Jess, when I'm looking at these for people, the blended rate doesn't make sense. And what I
right,
mean by that is like we look at the first mortgage, and let's say it's at that great 2.25 interest rate, but that second mortgage rate at 12, you throw them together in our blended calculator, and the blended rate may be 6. So then at that point, you might as well just go get a new mortgage to begin with.
right. I
So
know, and it's especially when you're talking about the blended rate, and I think it's important to be able to have that conversation with somebody, because again, not everybody's going to have 133,000 to put down,
yep.
and um, you know timelines, things like that. So just a quick plug to the interest rate reduction loan option that VA people have. That's important for, if you're listening now, to talk about just for a second, because rates are on the decrease. You do have to wait a certain timeline, but if you close the house in the next 30 days and you're at a 5% or, low fives, even if your chunk, one chunk was 2.37 and the second chunk is 9 or 10 or 12%, you're potentially much better off doing a loan now at the whatever market rate is, at the 5 and something, and then hoping that you can do an interest rate reduction loan, which is VA specific opportunity, the next little bit here. I mean, there's so many little math nuances to work out, and is it worth putting 5% down to get the second? Like, all those different pieces come into play, where cash is king, especially right now. So, and always, but especially now. So,
I
yeah.
think if you cannot put the money down, I don't think assumptions are the best route for us right now based on our current market. But flash forward 2 years, for folks that don't have, didn't get that $200,000 equity as the market just shot up, they're more likely to be closer to the sales price balance on their loan. And let's say instead of 100,000, it's $8,000. That's a lot more
Right.
doable for a lot of people. So I think that's where we'll really start seeing these come into play.
Yeah.
Now, why does a buyer want to do all this, Jess? I mean, the biggest, as we went in those slides earlier, illustrating the difference between the payment of $1,200 a month and $837 a month. That's the biggest thing, is the payment. But the other part, and the other reason you might want to consider this if you are a buyer, is the amortization schedule. Because just if your seller's house, if I remember correctly, they've been in the house like 3 years, right? Somewhere around there, two, 3 years.
Yeah,
Okay,
2 years.
so 2 years. Maybe not our best example for this, but let's say you've been in that house 7 years.
Right.
And now I assume his loan. I'm not assuming a 30-year fix from my perspective. I'm
Right.
assuming a 23-year loan,
Yeah.
and with that nice low payment. So he's
Yeah.
all they've already done the hard part of paying towards the principal. So now I'm just going to be able to pay that house off faster. So that's the benefit there.
Yeah, that's really interesting. Good point on that.
Yeah. Now, from the buying agent perspective, Jess, there's four things I feel a buying agent really needs to know for their clients. And the first one is, do you have the money to make this work? Because if you don't, then this isn't going to be the best route for you. Next, I want to know if my client has their full eligibility remaining.
Right.
And how you are going to find that out is your loan officer. Like if you and I are working this deal together, I would be able to present to you the client's eligibility. There is
Right.
nothing, there is the last four of their social on the document and their name. So there's not date of birth, there's not address, there's not account number, last four and their name. So it will be able to show whether they have their full eligibility remaining or not. I would really want to know the terms of the current loan. So like who's the lender, interest rate, all that good stuff is really going to be important. And I would need to know my buyer's time frame, because
Yes.
how many clients have you had that have said, I need to be in a house in 30 days?
Right. And before we get in the time frame things, I think that's an important piece. The first on your checklist here, that does my buyer have the needed funds? I know it's tough, and there's so many buyers prickle when we ask that. From an agent standpoint, when a lender asks, it's much easier because, of course, you're asking. You're a lender. You're the money guy.
Right.
And so, just for anyone out there who's purchasing, there's reasons why your agent and lender communicate closely, but there's also reasons why we as realtors are asking about money portions, because we have to figure out how to write the contract, how to protect you, what documentation are we going to need to submit with your offer, because you need a proof of funds letter. You might not want to send a snapshot of your entire balance. Maybe you only want a proof of funds letter needs to be requested from the bank. Some banks like Navy Federal will only mail you that letter, and it takes 10 days. So there's like a lot of different pieces that go into, just that one bullet of, do you have the funds? And if it's a yes, okay, great. Well, then we need to start going through these steps and get everything in order so that you don't miss the perfect house for you, because we're still waiting on a proof of funds letter to be mailed.
Right.
A lot of these banks, aren't used to doing it. It's hard to get them on the phone between 9 and 5 and lunch hours, and you got get in line, and then you wait if you're not willing to just provide a statement showing, maybe you were putting 100,000 down and the balance is way more. You don't want to disclose that information. Makes total sense. But this is why your agents are asking for this information. So
Correct. Yep. Let's see. There is a funding fee on these. It's very small. Now, if you want to find out more about assumptions, they can always reach out to me. But if I had a current VA loan, it wouldn't be a bad idea to reach out to your lender proactively if you are a potential seller for Jess coming up, and say, hey, I'd like to know what the steps are, because if you don't want to be trying to do that last minute.
Yeah. And Tanner, something I'm going to throw you a little curveball, something I didn't really think about too, is that, in Virginia, so it's specific to Virginia, if you're 100%, if you have 100% disability rating, you're not paying your real estate taxes on the first acre. So let's say, again, you're in this assumption process. The current homeowner is like, yeah, my payment is XYZ because I'm not paying real estate taxes. That's something that would be really important information for agents to know on both sides too, because if you're assuming a loan, and it doesn't affect the loan per se, but it will affect that monthly payment if the seller's not paying real estate taxes and you will be because you're either active or don't have 100%. So,
Yep, makes sense. Just three things about me, Jess. I like to make sure that my clients are kept up to date on the process. And every Tuesday, my team and I make calls to let everybody know where we are at in that process. So they are never in the dark. I'm like, what's going on with my loan? What's my situation? And closing times to me, Jess, are like Christmas. We know when Christmas is, and we are not missing Christmas. So those are my three things about me. And that's it.
yeah. And on that timeline too, because I know I interrupted you moving on to timelines. Like Tanner just mentioned, closing with Tanner, especially if you've already, gotten all your documents to him, we've done he's got everything. That closing timeline could potentially be 21 days if we're like really on the ball. The appraiser does their job on time, whereas an assumption could be 60, 75. It's a little bit more flexible, and it's a little bit more, it's almost like buying a short sale. You don't really know, you're really at that lender's mercy, where they probably are 9 to 5 and maybe in a different time zone, and like you don't have that local person you can walk into. So I think that's important too. So I know we touched on timeline a little bit, but it could take time, and it's important for the seller to realize, because not every seller is going to allow for that either. And not every seller is going to allow for assumption. I have some buyers who in the past have asked me for every single house, well, is there an assumable loan? And even if there is, it doesn't mean the seller is going to be willing to do that because of timeline. Or quite frankly, you're asking the seller to put some effort into your loan so that you can have a 2.3, like you can have theirs. So, I've encouraged my buyers who are interested in this to acknowledge that, and maybe have more favorable terms in the contract in other ways to help balance that out, because the seller is responsible for initiating it, getting the paperwork. They got to sit on hold forever to get someone on the phone to get that paperwork. I mean, there's effort that the seller has to put in on an assumption versus non. So if you're multiple offers this spring and there's an assumption and a non-assumption, and all other terms are equal or close, that could be a make it or break it. So something for buyers to consider.
Yeah, I would agree completely. So
Yeah. Yeah. Good. Well, I appreciate you running through all that. I think that's so important. I love your slides. It's
Well,
helpful to
thank
have
you.
the visual.
I like visuals. It makes it easier.
Yeah, absolutely. Well, thanks again, Tanner, for joining us today. And I'm going to throw up your information here. Actually, it should be showing. There it is. So if you guys have questions, feel free. Please reach out to Tanner. Call, text, all that kind of good stuff. Leave a comment. If you have questions or you've done an assumption recently, we would love to hear about what you've been through, what you saw, timelines, things like that too. Because they haven't been done, like Tanner was mentioning. It's not that your agent's like off, doesn't know what's going on. I mean, this is this assumption I have going on right now with my first one in almost 8 years of real estate, because they just weren't, it wasn't necessary. There weren't these low rates.
3%, right?
Yeah. And even now, I don't know how some people are walking around with the cash able to do that, like you said, the Delta. But so while they're becoming more common, I know other agents are seeing more also. Everyone has to bear. I feel like we're all relearning this process, or learning it for the first time, because it's been forever since this was
been part of our market really since 1999, 98, 97 timeframe. So it just hasn't been around. So
yeah. So, well, awesome. Well, thank you again, and we'll hopefully see you on another time.
Sounds good. Thanks, Jess.